What's up, y'all? Hey, when you get your mortgage finally, it's some words that you're gonna hear that you will not know. So that's what I want to talk to you about. The words whenever you get your mortgage. So the first thing is a mortgage payment. What is a mortgage payment? It's the amount a borrower pays to a lender to repay a mortgage. It typically includes principal, interest, taxes, and insurance. So that's going to be your mortgage payment. And it's kind of like paying rent every month. You're just paying it to a bank as opposed to a landlord. So that's what a mortgage payment is. And in this mortgage payment, it includes a couple things. The first is the principal. The principal is the original loan amount borrowed or the remaining unpaid portion of the loan. A part of each mortgage payment goes towards reducing this amount. So let's say you got $100,000 loan, you pay your mortgage payment for the month. Some of it goes towards the principal and some of it goes towards other things. And the other things that is going towards is interest. Interest is the cost of borrowing money from a lender, typically expressed as an annual percentage of the principal, the interest rate. So the interest is the extras you pay on the principal. So $100,000 and you're paying 5% interest, that's about $500, right? 5% of 100,000 is $5,000 of a year, right? That's the interest. So you're paying an extra 5,000 every year just for borrowing this $100,000. The next one is property taxes. So property taxes are taxes assessed by local governments based on the value of the property. They help fund public services such as school and infrastructure. So, one thing you can't escape is death and taxes. And property taxes are is one that you can't escape. Even if you pay off the house, you still got to pay property taxes because that's what's going towards building the new roads and helping with the schools in the area. So if you see that it's an area that have bad schools and things like that, it's probably because the houses in that area don't bring in much property taxes. They're not valuable. As opposed to if you go out to where the good schools and the good neighborhoods is, they pay higher property taxes. Therefore, they get better schools and better roads and things like that. So taxes are important. The next would be insurance. You have homeowners insurance that protects property damage, theft, and liability. And you have mortgage insurance. And it's required for borrowers who put down less than 20% of the home's value, protecting the lender in case of default. So, what that means is homeowners insurance protects you if a tree falls on your house, then insurance will pay to rebuild your house or fix it or pay you what the house is worth. That's what homeowners insurance is. And also, renter's insurance will protect you if somebody comes in and steals all of your stuff. You get it, you get the money back. Now, mortgage insurance is a little different. Let's say you bought the house and you only put 5% down. You have to have insurance just in case you don't pay the rest of it. The bank still gets their money. So you pay something called mortgage insurance. And what that is just protecting the bank if you didn't put 20% down. Now, if you put 20% down, your mortgage payments would be lower because you don't have that extra insurance on there. Okay. And all of this is showed in an amortization schedule. And that's a detailed showing, a table showing each mortgage payment over time, breaking down the amount applied towards the principal and the interest until the loan is fully paid off. So, an example of that, uh, would be just a piece of paper showing you how much you pay, how much you'll pay over time, and things like that. And all of these things that I just showed you is called pity: principal, insurance, taxes, and interest. So that's called the pity.